Good evening, everyone. I'll get started with a bit of housekeeping while folks are transferring over from the waiting room. So thank you all for joining us for Doctors of BC webinar, Building Resilient Medical Corporations. I'm Walter Lam from Physician Business Services, and joining us tonight is Sean from MNP and Elias from Watson Goepel as your presenters. I'm speaking to you tonight from Richmond and would like to acknowledge the land on which I reside on as the unceded territories of the Coast Salish peoples, including the territories of the Musqueam, Squamish, and Tsleil-Waututh nations. So thank you all for being here and the land which you are presented on tonight. I'm sure everyone is familiar with Zoom, so I'll go over housekeeping quickly. So this session will be recorded and shared on our business corner around next week or so. And on the Zoom toolbar, the chat function is open for tech difficulties, and the Q&A function is also open for you to send all your questions during the presentation. There will be a survey that pops up as you exit the webinar and also be emailed to your registered email. It would be appreciated if you can complete the survey so we can continue our future sessions. So what are we discussing tonight, this evening? We're excited to combine both tax and legal perspectives to engage in a comprehensive conversation about your medical corporations, covering some practical strategies and things you might not be aware of from the start to the end of your career, and how to create long-term sustainability for your practice. We really want to ensure that you leave tonight with valuable insights that you can apply to your business. Additionally, we appreciate the questions you submitted when you registered. Sean and Elias have incorporated some of the inquiries into the presentation, so a big thank you to all your contributions. So before we dive deeper into the content, let's take a moment for a quick poll. So this will just help us gauge tonight's participant level. While you're completing the poll, let me pass it over to Sean and Elias, and they will lead us through the next session. Thank you. On to you, Sean.
Thanks, Walter. So I've done a few of these, so I might be a familiar face, but my name's Sean Howe. I'm a partner at MNP in our Langley office, and I work primarily with healthcare professionals. So happy to be here tonight to walk through some things to consider.
And I'm Elias Natopoulos. I'm a senior associate at Watson Goepel, and it's my first presentation here with Doctors of BC, but I look forward to giving you guys some valuable insight on building resilient corporations.
And as we go through, feel free to put questions in the chat, and we'll try and stop along the way just to answer any of those questions that come up, or we'll leave some for the end. We also have a frequently asked questions just from some of the questions that you posted as part of registration. So I guess we get started, Elias.
Sure. So, based on the poll here, it looks like some of you, quite a few of you that have joined are new to practice. So this start of this presentation may be more applicable to you. It's always important to speak to your accountant or lawyer when wanting to incorporate a medical professional corporation. There's really some nuances and important considerations that you should make sure that you get right from the get-go. And it's a bit of a process dealing with the College of Physicians and Surgeons of BC. You need to first get your name approval done. So your Dr. John Doe Inc. And then once you submit that name reservation, you gotta submit it to the college and wait for approval from the college. And once you get that approval, then you work with your lawyer to incorporate your medical corporation, and you'll work with your accountant, set up your banking and all the necessary stuff surrounded with that. And then the final stage is you got to receive your permit from practice from the college.
Sounds good. Thanks, Elias. So let's kind of talk about what to consider when you're new to practice looking at incorporation in the first place. So I've kind of labeled out some advantages and disadvantages here and things to consider. What it really kind of boils down to is the most important thing is the top line there, which is tax deferral and savings. That's kind of the number one reason most people incorporate. So when we talk about tax deferral, what that means is are we able to push some of the bigger tax bills into the future rather than paying them now? So right now, your personal taxes, the highest tax rate is 53.5%, whereas most companies pay tax of 11%. So if you were to incorporate, you really only need to pay that corporate tax rate and then just pay personal when you actually pull the money out later in either whether it be in retirement or in future years. So the number one question we kind of go through is, are you making more money every year than you need to live? Because that gap between what you're making and what you're spending, that's the opportunity for that tax deferral. So a lot of times when someone is brand new to practice, we'll have the conversation saying, well, what is your budget versus how much are you expecting to make? That's going to be one part. But then we're also going to look and say, do you have any big upcoming purchases? Do you need to pull all the money out for a home down payment? Or you have any big purchases with a car or anything like that coming up in the near future? That's going to make you pull the money out. If we can get to the point where it's, yes, we're making way more money than we actually need to live, there's no big purchases coming up, that's when we really start diving into, yes, it makes sense to incorporate, and you're going to start building up your retirement nest egg and all your investments at the corporate level. Okay. But the big thing is just to consider that if you don't have that deferral, like if you are spending everything, setting up the company isn't really going to save you any tax. In fact, it could actually cost you a little bit more in tax, as well as increased administrative work, increased fees, that type of thing unnecessarily. So you definitely want to make sure that it actually does make sense. And that starting point is usually a conversation with your accountant or advisor. So other considerations with the corporation. So what corporate structure is allowed? So after we pass that first step of, yes, it does make sense to incorporate, you're making enough, you're going to see enough benefit to do it. Then it goes to the next step of what corporate structure is allowed. So as a physician, you do need to own 100% of the votes of your business, but you can have immediate family members as non-voting shareholders. So most common structures we see would be the physician owning 100% of the votes, and then usually it's a spouse coming in as a non-voting shareholder. The shares that the spouse owns in the short term don't provide much in the way of benefit because income splitting has gotten harder over the last number of years. But where it does benefit is allowing your spouse to accrue value in the corporation so that in retirement, when we are able to income split, they have a share, they've earned part of the value within the company structure to allow us to pay those dividends. So that's the most common structure, but each individual is going to have their own circumstances. Like if there's US citizens in the structure or in the family, then we're obviously going to have different implications than if it's all Canadian. As for what you can hold in your professional corporation, so if we've done this right and there is a big tax deferral and you are making more money than you need to live, the money in your corporation is going to start to build up. So in most cases, a lot of the new physicians we see will just have it in marketable securities, GICs, some sort of passive investment. So any passive investment like that can be held within your professional corporation. No need for any second. But if you do start to get into more active businesses, so if you are randomly going to start up a McDonald's franchise or anything like that, that should be held in a separate corporation. And that's more of a college rule to make sure that you're not mixing the active businesses. The one gray area here is real estate. So the college has previously come out and indicated that they don't like real estate in a professional corporation if it isn't used in the active business, like for a clinic. So in most cases, we advise having a holding company if you're going to own any rental properties or anything like that. But that's kind of an ongoing discussion to discuss the pros and cons. So once the company is set up, then we go to the CRA and we need to determine what accounts are needed. So the default account you're going to have is what's called an RC account or corporate tax account. So that's just going to be for your regular corporate tax filings. But going forward, we would want to have the discussion. If you're going to be on payroll, we need to call the CRA and set up a payroll account. If you're doing any cosmetic work or any work that would require GST to be charged, we should set up a GST account. Same thing with dividends, we should set up an RZ. So it's really just a conversation of what you're going to be using your company for, and then making sure all the CRA accounts are set up accordingly. Tax filings. So corporations are a little bit different than personal, being that filings are done based on what's called a fiscal year. So it's really any 12-month period. So from the day you incorporate, you actually have 53 weeks to have your first fiscal year end. So one of the first things we'll do after you're fully incorporated is have that discussion of, do we want to have the year end out as long as possible to defer your tax and filings? Or do you want it to be December 31st to match up with your personal filings? Or do you have a preference of another month? Maybe it's a slow time of year for you and you want it lined up with that so that you're have more time to work on the year end. So it's kind of a discussion there of what fiscal year end works best for you and your timing. Once that's determined, tax filings. So we need to file corporate tax returns 6 months after year end. But any taxes owing are due typically 3 months, in some cases 2, but for most physicians, it's 3 months after year end. So for example, if somebody incorporated today, most cases we would have their first year end be September 30th, 2026 to just kind of push it out as long as possible and defer those taxes. And if that's the case, any taxes owing would be due by December 31st, and the actual filing would be due March 31st. And lastly, probably the biggest question we get after someone incorporates is, what can you write off now that you're incorporated? And the answer is very similar to what you could have written off as a self-employed individual. So this isn't typically the answer or the reason why you would incorporate in the first place, because your write-offs are very similar, albeit they're looked at less closely by the CRA once incorporated from my experience. The kind of rule of thumb of what you can incorporate or what you can write off is going to be, if you've incurred any expenses or paid any fees in order to do your job or in order to earn your income. So for good examples would be if you're buying office supplies, if you're going for meals with colleagues to talk about work, any training or education or travel for that, really any costs that you're incurring in order to do your job. That's back to OS.
Yeah, thanks, Sean. Also, just a little administrative item, I guess we didn't mention in the beginning of the presentation. There's we've received some questions in the chat function of the presentation here. Sean and I will leave some time towards the end to maybe answer some of these questions and some of the frequently asked questions. So we have seen your questions, and we'll get back to it probably at the end of the presentation, if not answered throughout. Okay. So I guess we started off talking about, incorporating your medical corporation. Sean just touched a little bit about some advantages and disadvantages with respect to, tax issues. So, I mean, now we get to the point where if we're gonna, go holistically throughout the whole stage of your career, we're sort of in the middle of your practice now, where you're trying to think about, okay, coming back to what Sean said, do I have more money in the company than I need? Or, starting to think about, retirement or succession planning. So at this stage, you really got to define some clear goals and reasons for wanting to make some changes to your corporate structure. And, analyze if this structure, if your current structure really meets your goals and objectives. And if there's any, sort of strengths and weaknesses that you want to improve on, and then work with your advisors, both your lawyer and your accountant, on a structure that really aligns with your future goals and objectives. This will sort of segue into some more stuff that Sean and I are going to talk about now about some planning opportunities.
Sounds good. And I'm just going to answer some of these questions in the Q&A. I didn't see them before, so I'll just answer a few of those before jumping into my next slide.
Okay, sure.
Just while they're still applicable. So first one is, can you explain a little Walter, can everybody see the questions or just me?
Just us.
Okay, so I'll list them first. So can you explain a little more about how non-voting shares owned by spouse in the medical court may be beneficial later on? So with income splitting, there's a rule called TOSI, which is tax on split income. So came out in 2018 where the government basically said you can't freely income split anymore. But one of the considerations they said was once the main earner, so in this case, the physician, turns 65, they can start income splitting from their company again with their spouse. But in order for the spouse to receive dividends in retirement, they need to be a shareholder of the company, right? So first off, that's why they would be a shareholder. Why you would pay them or make them a shareholder now or early on is so that they can participate in the future growth. So from the time it started till retirement, now they're effectively, their shares are owed about half the value of the business. Whereas if you bring them in as a shareholder right at retirement, you're likely going to have to do some sort of freeze, which limits how much value is allocated to those shares that the spouse owns. So that's kind of why it would be beneficial. And really, there's very little downside to having them as a non-voting shareholder, assuming they don't have US citizenship or don't have their own company. So that's kind of the main reason we set it up that way. Next one is, if I get a loan from my corporation, how can I calculate the interest to pay it back and how much should be the interest rate? So interest rate typically would follow what's called the CRA prescribed rate, which is currently at 3%, but it does go up and down with inflation. So you should keep an eye on that. As for the actual loan from your incorporation, that should be a discussion between you and your accountant or advisor, because there are some issues with having what are called shareholder loans for longer periods of time. Within 2 years, it's not a significant issue, but as you start to go outside of 2 years, there is the chance that the CRA comes back and puts the full loan into your income in the year you took it out, because there's limits on how long you can have a shareholder loan outstanding. So I think that would be one that I would advise making sure you're having a discussion with someone about the risks of that. And the last one's a bit of a long one. I've been in practice for 40 years, paid thousands of dollars to accountants and spent hundreds of hours trying to figure all this out. I've deferred tax, but now that I'm pulling funds out of the corporation, I'm still in the top tax bracket and taxes are even higher than they were before. Would I have been better off to just pay the taxes at the beginning when they were lower rather than deferring them to now when taxes are higher? So this one is, we should look at it specifically your case to get a proper answer. But the short answer in my mind would be no, because you've now had, call it 40 years of growth on that deferred tax. So say you would have paid 50% of tax up front, but instead you paid 11 or 12, whatever the tax rate was at that time, that extra 38% that would have gone to the government back then, instead you've put it into investments presumably, and that's built and grown and compounded over the last 40 years to make your corporation that much, that have that much more money up front. As for taking the money out in retirement, ideally you're coming up with plans for how most tax efficiently to take that out to try and keep you out of the top tax bracket. Sometimes it's not avoidable, just depending on what your cash flow needs are. But I think that comes down to just planning with your accountant to make sure. I would be very surprised if you'd be worse off by incorporating under that, just because of how much bigger your corporation is than what your personal investments would have been if you didn't incorporate. But hopefully that answers the question, but if not, feel free to reach out. I'm happy to kind of walk through that. And then last one I have here is, does moving money from my Medco to Holdco trigger any tax implications? Put another way, can I move funds from a Medco to Holdco tax-free? There's a couple different things to consider here. You can move money over as a loan, an intercompany loan. So if you're just trying to move cash over for investments or anything like that, that's usually done just as a intercompany loan, which is all tax-free. If you were wanting to actually shift value and like your retained earnings outward, You would need to do that through usually an intercompany dividend, which could have some tax implications. Usually it's tax-free, but there are some provisions of the Income Tax Act that you could get caught by. So it really depends what your goals are, but either way, there is a way to get the money over to your holdco tax-free, whether it happens automatically or whether it takes some intervention. Sorry, after that nice little intermission, we'll move on. So following up on what Elias said about reorganizations and restructuring, I just wanted, everyone seems to be at different stages of their career, so wanted to just go through some of the common reorganizations that I see in my practice, because it likely applies to a lot of physicians. So first one, which we've kind of talked about a bit already, would be a holding company. So when is a holding company needed? It's usually needed for if you're wanting to get involved in another active business, if you're wanting to hold real estate that may or may not be active in your business. So real estate holdings. And I've also seen in cases with trying to mitigate some risk or have some asset protection. Elias might be able to talk on this more, but typically I see that a physician, if they were going to be sued for malpractice, that would typically go to them individually and see right through the corporation. But there could be some arguments for it. Say, for example, if somebody trips and falls at your practice or something along those lines, that having a holding company would provide a little bit of asset protection.
That's exactly right, Sean. Usually the malpractice suits are with the physician themselves. But a slip and fall or something, you will have some creditor protection by separating it out into the holding company.
Family trusts. I've had a number of clients come to me and say they need a family trust, and most of them don't know why they need a trust. They just heard of somebody who had one. So family trust used to be a lot more popular when income splitting was around, because you'd have a family trust with children in there and everybody would get a dividend from the company and everybody was happy because nobody paid tax. That all changed back in 2018 with all these income splitting rules that made it a lot more complicated. Now where I see family trusts coming more into play would be if you happen to have a saleable business, which we'll talk a little bit more about purification. Most physicians, it isn't, but there is the odd case. For physicians in particular, where we see the family trust come in is more so for estate planning. So if we're in a situation where we're going to do a freeze, which we'll talk about next, we could bring a family trust in, which would help distribute the wealth among different beneficiaries without giving them direct ownership. So usually a family trust comes into play in the same conversation as a estate freeze, and that's when you have more money in your company than you need to live for the rest of your life. So I'll kind of talk about estate freeze, which is the same thing. It's you have more money in your company than you need to live. So for example, I have a client I met with the other day that has about 10 million in their company. They're retired, they're 70, and based on how much they're spending, they're never going to go through all that money. So that kind of led to conversations of, well, what's going to happen with this upon your passing? And they wanted it to go split between their kids. So easy conversation of, okay, you're never going to spend all this money. Every year that you're accruing income in this company, you're increasing your estate tax liability because you're increasing the value that you personally hold. So what an estate freeze is it freezes that value. So in this case, it would freeze the 10 million to the two shareholders, or the physician and their spouse. It would freeze that value, and then all future value would go to either a family trust with the kids as beneficiaries or the kids directly. And then what happens is every year when the physician and spouse take their dividends to live, it decreases that $10 million value that they hold and increases the value that the kids hold. So it's effectively transitioning the wealth to the kids now while they're alive to reduce the amount that they hold in their estate. Purification, again, this is more specific if you have like a cosmetic type business or a specialty business that can actually be sold. In a case like that, purification is we want all of the assets to be active in nature so that it's ready to be sold to another professional. Change in shareholders. We talked about it a little bit with the spouse. I think that was one of the questions. A lot of the times when we incorporate physicians, they're fresh out of school, they're single or not married anyways. So they're often the only shareholder when we set it up. But circumstances change and they could get married. They may want to have a family and they want to change their share structure to include their spouse so that they increase in value or participate in that increase in value so that it's all ready for retirement. So that's the most common one that we see, other than when you bring in the holding company. Like if you're doing another transaction, you might want to change the shareholders at the same time because it's easily done while the accountants and lawyers are already in the mix and already involved in the structure. And the last one isn't so much a reorganization as it is just something that should be looked at on a regular basis, which is capital dividends and the capital dividend account. So first off, what a capital dividend account is a tax-free amount that you can pay out to yourself as an individual. And how it is built up is typically through capital gains. So whenever you have a capital gain in a company, only half of that capital gain is taxable. So the half that is not taxable goes into this notional capital dividend account. And then as it builds up, we can file an election. So there is some accounting and legal involved in the election, but file an election to get that amount out to you as an individual shareholder tax-free. So this happened a lot last June when the government threatened to increase the capital gain inclusion rate. There were a number of people who triggered capital gains to lock in their 50% inclusion, which created big capital dividend accounts for a number of them. So now we're taking advantage of that side of things and we're paying out all this tax-free money to those individuals. Pass back to Elias.
Thanks, Sean. Okay, so now we're going to move towards the part of your career where you may want to sell your business or transfer it to a family member or the next generation. So I guess number one here, capital gains tax. Sean's talked about it a little bit already, but for those of you where you have a business that is able to be sold, most medcos aren't. But there's certain, medical spas, for example, that are allowed to. Assuming you meet the purification tests and stuff, which Sean mentioned in his previous slide, we do have something called the lifetime capital gains exemption, where you can shelter. I think currently it's about 1.25 million in taxable capital gains available to you when you sell a business. There's also, every time an individual dies, there's, it triggers tax on death, right? You're deemed to have disposed of all of your assets at fair market value when they die, and it triggers a bunch of tax. So there's some strategies that you can implement to, defer or delay this tax, such as a spousal rollover. So assets transferred to, your surviving spouse or common law partner are not subject to immediate taxation. Instead, the tax liability will become due and will be deferred until the surviving spouse disposes of the assets or passes away. There's also other strategies you can use to implement in your estate plan, such as doing charitable donations in your will, which will yield certain tax credits that you can use to offset income in your terminal return. All right, so on the whole sort of topic of estate planning, there's some useful tools out there that you can utilize, such as getting a will. You'd be surprised, most people don't have a will, but it is an important thing that you should consider putting in place, because it will, you know, prevent headaches for, you know, your heirs, you know, down the line. You know, a well-drafted will is a fundamental tool because it outlines how you want your assets to go and be distributed when you pass away, including your business interests. So, you know, you can appoint an executor to manage your estate and your assets, and ensure that your wishes are fully fulfilled. We've touched a little bit today about trusts, but trust can be a valuable tool for estate planning. You know, such as family trusts, as Sean mentioned, in sort of estate freeze scenarios. But there's also joint partner trusts or alter ego trusts, which, you know, there's got certain criteria. You must be, you know, over 65 years old, for example. But these type of trusts are very useful because they, you know, not only offer asset protection, but they help you with some tax deferrals, quite significant ones. So these are types of trusts that you should, you know, be consulting with your advisors, your accountants, and your lawyers from when it comes time to, you know, putting your estate plan together. And then there's powers of attorney. You know, if you're unable to wake up and you're in their hospital bed, are you leaving the right people control? So, you know, the powers of attorney are legal documents that allow you to appoint somebody to manage your affairs when you're not able to. There's also powers of attorney for health. So if you're incapacitated, somebody's going to be making, you know, healthcare decisions for you. So it's very important to be picking the right people here and people that you trust to do these sort of acts for you. And lastly, there's life insurance. So obviously, you can have life insurance to provide financial security for your family and your business upon death. Life insurance can be used to, if you have a partner, sort of fund the buyout of your estate if you pass away. It can also be used to pay a big tax bill on death. So it's a very important tool that you know, you should consider implementing, you know, early on in your practice. And I guess I'll pass that on to Sean now.
Okay, so I'm touching on some of the same topics that Elias touched on, but I'll talk on it more from an accounting standpoint. So estate freeze, I've already talked about it a couple times here, so I won't go into that. Big factor to look in there is, are you in retirement and you have more money in your company than you're ever going to get through in your life, and you want a tax efficient way to pass it on? That's going to be the main trigger for you to have that conversation. Life insurance, again, it was mentioned. I'd say the big factors here is there's a lot of people out there wanting to sell life insurance. So you want to be very careful and aware of what you're buying and why you're buying it, because there are different types and they have different reasons for having them. Like term life insurance is very good for protection. So you have a young family, you want to make sure they're protected if something happens to you unexpectedly. Term insurance likely isn't the insurance you want if you're thinking it's actually going to pay out, because most times term insurance doesn't, because it gets too expensive by the time you get old age. It's better for those unexpected. But then there's like whole life and universal policies, which these are best in place if you need to cover an estate tax bill or if you're trying to pass wealth down to the next generation. So I think the big takeaway here on the life insurance is, if you're going to get it, you should have a very good idea why you're getting it, what you're trying to protect, and how much you actually need. Okay, so obviously life insurance is a good way to cover tax bills, preserve wealth for the next generation. But I do think there's some times where it's even more important than others. For example, I have one client that is very heavily invested in real estate, that if they were to pass away, their estate tax bill just on all the accrued growth on all the properties is going to be far more than they actually have in liquid assets. So what's going to happen there is you're going to have basically a big tax bill, but not enough money left over. Okay, so those are ones that is going to be very important, that they may not have even been aware of that situation, but their kids or the beneficiaries would have been in a bit of a pickle there trying to figure out how to pay it. Otherwise, like you could just have liquid investments, in which case it's, yes, they could just sell the investments, pay the tax. It's just going to be a cheaper way in most cases if you have life insurance that's going to kick in to pay it. But again, talk to your insurance advisor, see what the options they have and presentations. And then I usually recommend getting kind of talking to your accountant as well, just running it by them just to make sure that everyone's on the same page. Income splitting in retirement. So I already kind of touched on it when answering one of the questions that came up earlier. But basically, once the physician or the main earner turns 65, we can freely income split from the company again. So the changes needed now would be just making sure that whoever you want to income split with is actually a shareholder. Because if they don't have shares, they can't receive dividends, because dividends are just paid on the shares that are outstanding in the company. So I guess the whole reason why they allow it at 65 is to kind of mimic other pensions. So other pension income you receive, you can split as well, and that's all done through your personal taxes. Now, as you transition to retirement, typically how that works is if you have a professional company and a holding company, once you retire, you're going to remove your license from the operating company to be left with two holding companies. Then you're just going to amalgamate them, try and make things as simple as possible. Or if you just have an operating company, you're just going to de-license, change the name, and it effectively becomes a holding company. But then you're left with a big lump sum within the corporation, and now it's time to start drawing that value down. So the value you've been building up throughout your career, now it's time to start spending it, because no money's coming in to replace it. So that's where it comes down to numbers 4 and 5 here. So drawing down the tax deferred assets and balancing your income sources. So tax deferred assets would be ones where you haven't yet paid personal tax on it. So the two main ones you're going to see are your corporation, because it's built up all these assets, and your RRSPs, because that's all been tax saved so far, and both of them are going to be taxable when you take them out. So when balancing retirement funds, the approach I typically take is, how much money do you need in retirement? How much of it is coming from fixed sources like CPP and OAS that we can't really control, or RIF if you're already into the RIF, and then figuring out how much more we can take from the company or RRSP to get you up to the ideal tax bracket. And that answer isn't the same for everyone. We have some clients that want to keep their OAS, they don't want to have the clawback. So they want to keep their income under, call it 95,000. So we work into those parameters. We have others that are saying, well, I have to draw all this value down before I pass away to keep my estate down. So let's get our income right up to the top tax bracket of 250. So it is a different answer for everyone, and it's going to depend how much you have in your company, how much you have in RRSPs, what your lifestyle is. But it is, you definitely want to have that conversation to make sure, both with financial advisor and accountant, just to make sure there's enough money to last for your retirement, and also making sure it's done in a tax efficient manner, because you don't want to go into retirement and taking 30,000 a year of income and find out that now your estate taxes is millions because you've left all this money in tax deferred accounts. And then last one is probate planning. So essentially, as part of passing away, there's a probate fee of 1.4%. Elias might be able to talk more on this, but there's a 1.4% probate fee for anything that goes through there. So depending on how big your estate is projected to be, we could look at planning options. So it could be, do we want to have an alter ego or joint spousal trust that Elias talked about that keeps things out of the will? Or do we want to have a second will for the corporation? So you could have a 2-will scenario where one of them avoids probate. So it's more so just take a step back. What is the projected estate going to be? Is the probate on that enough to warrant special planning to preserve the estate or preserve the wealth? And I guess one other thing on the joint spousal, or more so the alter ego trust and joint spousal trust, another time I've seen this come into play is if there is going to potentially be a dispute of the will. So what happens is any assets within that trust bypass the will. So they get allocated to the beneficiaries in line with the trust and aren't subject to the same ability for will's variation. So I see that sometimes in cases where there's, I don't know how to say it nicely, but delinquent children or second marriages or things like that, where there is that risk. That's just an added protection. And then moving on to the frequently asked questions. So we have some that we kind of took from the Excel sheet, and then I'll see if I can get to the questions that have been posed live. So what happens to the corporation in retirement? How do we draw down value? What if there's a holding company? So I kind of touched on that in the last one. The operating company is simply going to deregister from the college, take its license out, and change its name, and it becomes a holding company. If you have already had a holding company, we often see them being amalgamated or wound up so that you're only left with one, just to keep things simple. And then you draw that down in retirement, and how quickly or slowly you do it depends on your own personal circumstances. If it's too slowly, that's where the estate freeze comes into play. How do we transition the practice to other physicians? So this one really depends on your practice itself. Like, do you have a cost share structure, or do you own the real estate? Do you own the practice itself? If it is a practice that actually has value, then we'd typically be looking at them buying either the shares from you or buying shares from Treasury to get into the practice. If it isn't a practice with any significant value, then it would typically be just bringing them in as one of the owners. Usually the value that they're going to want to pay for is going to be like the leasehold improvements and the equipment, which depending on the timing may or may not have value. So that one's probably best to have a one-on-one conversation with your advisor, just to walk through exactly what the circumstances are and when you're trying to bring them in. What are implications of having a joint corp with a physician's spouse? So presumably this is one where both spouses are physicians. So there's kind of two to three different ways I've seen this done. And the main factor I would say that comes into play is, what is the overall net income going to be combined? And the reason I say that is for what's called the small business deduction. So essentially on your first $500,000 of net income in your corporation, you pay 11% tax. But if you and your spouse are both physicians and you're leaving more than $500,000 in the company, then it may be beneficial for each of you to have your own completely separate corporation, because then each of you would get that $500,000 limit. So I do have some clients where they have a joint corp with their physician spouse because their overall net income is right around or close to that 500,000, where it doesn't warrant a second. I've had other ones where their combined income was going to be high enough that it justified having a second corporation. When do you incorporate, and how do you leverage the corporation for tax efficiency? Hopefully I've already kind of answered that a few times with the tax deferral and answered with the person that's had a corporation for a while. So the main thing is deferring the tax and having more money up front that will compound and build in investments. What happens to the corporation when I pass away? So Liz, you might want to jump in on this one as well, but typically if you were, I guess it's different if you're operating or like an active physician at the time you pass or not, but assuming you're not, and it's just a holding company at the time, it would typically pass to the spouse, assuming the will says so, the shares would just transfer over. If it's the second person to pass away and they own the shares and it's going to the next generation, for example, that's where there can be significant tax implications. So that's where there would be a deemed disposition of those shares, which can cause a tax bill to the estate. But then the risk we run without doing some proper planning after passing is double taxation, because you could end up paying tax there and then paying tax again when you take the money out in dividends. So there's some planning there. I don't know if there's anything you want to add to that, Elias.
No, that pretty much nailed it on the head. You know, one thing I may add is, you know, you may want to think about you know, nominating if it's already, you know, you've passed and the company's now gone to your spouse at that time, you know, you may want to consider, you know, depending on the age of the spouse or whatever, maybe nominating somebody else to act as a director so that there's some, you know, somebody with authority that can actually do stuff for the company, you know, pay bills and that sort of thing. You know, during the time between the death and appointing your executor, because sometimes I've seen it in practice where, you know, it takes some time to get probate done and, you know, get all that stuff sort of done, but, you know, company has certain bills and stuff that needs to get paid, but no one to be able to do it. So that's just some smart planning tip just to keep in mind.
And then last one I had here as one of the questions that came up was cost sharing structures. What are they and how do they work? So what a cost sharing structure is essentially if you have two or more physicians in a practice, they're sharing the space, but they're each seeing their own patients. So this has become more common now because of different tax rules that came out in 2018 that limited the multiplication of the small business deduction. So cost sharing structure is essentially each physician is running their own practice. They do their own billings to the government, and they're just funneling money into either a joint corporation or joint bank account to pay the costs of the practice. So it's basically every physician is their own business. It's just they're doing this for cost savings. Big things here is if you're going to do a cost share structure, make sure that you're actually following the agreement that you put in place, because you do run some risks of running into GST or being a separate business. You want it seen as very much a you're paying back the costs that were incurred rather than paying a management fee. And it looks like Walter just put in a template for cost sharing into the chat, so everyone can kind of take a look at that. Okay. And then looks like there's a handful of questions in here in the Q&A. Elias, do you see any that are there for you?
Maybe when can I make a child a shareholder and at what age? What are the advantages and disadvantages of doing this? I mean, somebody can become a shareholder, you know, as young as you think they, you know, have the capacity and the understanding to do so. Because keep in mind, as a shareholder, depending on the share class that they have, you know, they're going to be able to have certain rights and responsibilities. So you want to make sure that the person is old enough to understand that, you know, they have decision-making power if they're a voting shareholder or if they're a non-voting shareholder. So I guess it really comes down to, you know, your personal circumstances and your relationship with your child and, you know, the amount of autonomy and trust that you have in them. I don't know if there's anything further you want to add from a tax perspective, Sean, but.
Yeah, like I would just say it doesn't create much tax advantage to do it early or when they're young. Usually where we would bring them in as a shareholder is as part of those estate freezes or later on in your life when you really are trying to transition the wealth to them. Because previously we would do it all the time with having children in, but that was when we could income split with them. We could pay dividends out. A lot of the times you would pay out the money to the kids so that they could pay tuition. But with all of that gone and with punitive tax rules with income splitting, there's not the same advantage to bringing children in as there used to be.
Okay, there's another one here. When is it better to purchase investment real estate in your personal name or in your corporate name, and not counting your principal residence? I guess this is really fact specific as well. If the real estate's going to be an investment and you're going to be renting it out, it's probably better to purchase it in a corporation so that you can, you know, have certain write-offs and that sort of thing rather than doing it in your personal name. Also for creditor protection purposes. Again, somebody slips and falls in your rental property, then, you know, they can't sue you personally. If it's in your corporate name, you have some creditor protection there. a little bit of some. Anyways, I don't know if you have anything to add to that, Sean.
Yeah, like I would say a little bit depends on what the property is for. You obviously mentioned not principal residence. Please don't put your principal residence in a company. If it's going to be a personal use cottage or vacation property or something along those lines, we may want to have that conversation about whether a company or personal makes more sense. Usually it would be personal because it's personal use. But if it is like a rental property, most common would be in the company. I would say the biggest reason from a tax perspective to do that is because the funds that you're likely to use to buy that property are corporation dollars. So if you were to buy them personally, you would have to pull all that money out, pay tax on the dividend or salary, and then use the after-tax dollars. Whereas if you're going to use it in a holding company, you can loan the money over, and after paying the 11% tax in the company, you have 89 cents on the dollar to invest in that real estate. Whereas if it was personal, you might only be left with about 50 cents on the dollar to invest in the real estate. Once age 65 and eligible for income splitting, my wife and children are shareholders. I know I can split with my wife. Can I do it with the adult children? So the income splitting rules only allow for you to freely split with your spouse once you're past 65. So the only way you're going to be income splitting with adult children under the new regime is if they're earning it. So you can pay dividends at any time, really, if dividends or salary, if they're providing some value to the corporation that you're compensating them a reasonable amount for. So in most cases, we do that through salary instead of dividends, just because it's a little bit more straightforward and in line with paying them for services provided. But to freely income split with the adult children wouldn't typically be available in this case. Not like it used to. Okay, what would be the most common shareholder structure when we add our spouse to the picture? Will it be 50% voting owned by the physician, 50% voting shares owned by the spouse? I might be a little bit biased because of the way I always set up companies, so I just might have a different one, but I typically have the physician always owning 100% of the voting non-participating shares, meaning a very specific class that gives them the votes, but they can't get dividends on. And then owning a second class that is non-voting, but they can receive dividends. So if I were to bring a spouse in, I would have a third class where, again, they don't vote, but they do get to participate in dividends. So I personally just like to separate the votes from the dividend entitlement. So essentially the physician in that case would own 100% of two different classes of shares, and then the spouse would own a third independent one.
The benefit of that also is with the structure that Sean just mentioned is having two different classes of non-voting shares that have dividend entitlements. You're allowed to pay different amount of dividends to husband and wife or partner and partner. So that allows you some flexibility there.
Okay, if I have GIF seg funds that I may hold in my corporation into and past my retirement, as the guaranteed maturity value is guaranteed on a date when I may have already retired, how much are the costs to keep corporation alive beyond working life? No children, no spouse to consider. I mean, to be honest, that's a very personal one, because without knowing the details of those investments, the seg funds, how much bookkeeping is involved in the investment side, it's a little bit tough to properly quote on it. Obviously, it should be less than when you were operating and working at the time, but it's tough to give a proper quote on that. So I would defer to talking to your accountant. If you're wanting a second opinion, talking to another one just to see what they would quote on that specific work. But it's tough to do in this. Tough to give a quote with that information. Okay. What happens if I move to another country later in life? Can I still draw from my corporation as salary dividend as usual? What if I claim to be a resident in another country, not in Canada? Can I still pay myself from my corporation? So this one is quite complicated, this question. So typically when you leave Canada, you're going to have what's called a deemed disposition when you leave. So basically the Canadian government's going to look at all the value that you've accrued while in Canada, and they're going to charge you a tax at the date you leave on all that accrued gain. There's some exceptions like principal residence, real estate has some, all the different assets have different special rules to them. But essentially they're going to lock in that value. You're going to pay tax on those shares before you leave. And then when you're in the other country, if you were going to take dividends out, you can take them, but there's going to be some tax implications. So it's a long-winded way of saying if this is your circumstance, you should definitely be getting some advice on what to do before you leave, because it could be a case where you're better off trying to draw down the value of your company before you leave so that you don't have that deemed disposition with a higher share cost base. So I don't know if you have any cross-border familiarity, Elias, you want to add to that, but I think we need more answer to give it more information to give it a proper answer. And given the details of that one, I think it would warrant a one-on-one with either one of us or your advisor.
Yeah, no, I totally agree with that. There's a lot going on in this question and a lot of different factors that can change things. You know, happy to discuss at another time, or you should discuss with your advisor.
Yeah. Okay. What are the risks of universal life policy joint last to die within the company? I understand I'm able to borrow against the insured value tax-free with the interest covered by the insurance. Okay, so you're getting into a little bit more aggressive of a plan depending how you're borrowing against that insured value tax-free. So I'll start with the universal life policy. So the universal life policy owned by the company, joint last to die, meaning it likely covers two people and it pays on the passing of the second. I wouldn't say there's risks there. Like your life insurance policy can certainly be held by the company. The company should be the owner and beneficiary. When it pays out, it'll go into that capital dividend account I talked about earlier. That can be allowed, or that will allow you to pay it out tax-free. One big thing you want to be aware of is if any of your beneficiaries of your will are US citizens and you have this set up, that can be pretty significant tax implications because that capital dividend that's tax-free in Canada isn't in the US. So you could run into some issues there. As for the borrowing against the insured value tax-free with insurance or interest covered by the insurance, I'm thinking what you're meaning is you're taking a personal loan out that is secured by that life insurance policy. So when the policy pays out, it pays this loan off. There is some risk there because you are accruing interest, which depending on your age, that number could end up being pretty significant. So your debt is going to be pretty significant by the time you pass if you keep borrowing against that policy. You run the risk of the policy, which basically earns its income on a dividend scale. You run the risk that dividend scale drops below the interest rate. If that happens, then you could actually have to pay money in to keep the cash surrender value high enough to justify that loan. The CRA risk you run with it is if you're getting a better interest rate on your personal loan because of a company asset, there could be a deemed tax benefit to you personally. In a lot of cases, it can be mitigated by just showing that you could have got the loan elsewhere. You could have had that interest rate anyways. But those are kind of the main risks that come to mind when I see those plans. You say all costs for running the business are tax deductible. Does that include costs which are made to companies abroad? So I guess it depends what you mean by that. Like if you mean that you're paying to a company in the States for training and you're flying down there for training in order to better do your job, then yes, that's allowed. Or if you're paying to an American company that's providing you a service in Canada that to better your job, then yes, that would be allowed. If you mean that you're incurring costs for a foreign company that's not your immediate company, then that's a little bit of a gray area and likely a no, depending on the specifics. But just because if you're incurring costs for your corporation in Canada, even if you're paying it to a foreign company or an American company, that would still be deductible.
I think that's like all the, I'll pass it on to Walter. I think that's all the questions.
Yeah, that's all the questions we have. And we're actually at time. So lots of great info and questions tonight. Good job, both sides. So you might have more detailed questions as you reflect later on. So you can leave those comments and inquiries in the survey or send it directly to Physician Business Services. You also have Sean and Elias' contact here, so you can take that down and email or phone them if you have more questions. So thank you, Sean, Elias, and all the attendees for attending tonight. The recording will be uploaded onto Business Corner in a week or so. So have a good rest of the night and see you next time at another PBS webinar. We have quite a few physician-led CA accredited sessions upcoming from now to December. So do check out upcoming events under news and events on Doctors of BC website. Thank you, everyone, and have a good evening.
Thanks, Walter. Thanks, everyone.
Thanks, everyone. Have a great evening.